Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Ross Clark from CIBC Wood Gundy is back here with us on This Week in Money, and we are sure glad he is. Just back from a Baltic cruise. On the surface, Ross, it looks like not much has changed since you left. U.S. Federal Chairman Ben Bernanke making news this week, reassuring markets that your kindly old Uncle Ben is not going to take the lollipops away anytime soon.
Yeah, well, just before I went on holiday, they were alluding to the fact that things were getting better and that they might be looking to ease. So, what happens? The bond market sells off from early May by a good 20 points. Yields in the U.S. make a dramatic move to the upside, and it's interesting to look back on it from both the perspective of the news and then perspective of what the charts have been looking like for the last year or so.
Yeah, let's look at that. And technically, what happened on Wednesday? The big change in just about everything.
Yep. It was there we were sitting at Wednesday afternoon, Wednesday evening, looking at the quote screen coming back after the market had closed, and all of a sudden it looked like the odd misprint, and then it became many misprints. Some of the, as Bernanke was following up in discussions and after the FOMC minutes had been released, which really were a mixed bag in terms of the opinions of the various governors, Bernanke's comments clearly along the lines that he wasn't seeing as strong an economy as might have been alluded to. The employment figures may not be as good as they look, and that QE is still on the table and for who knows how long. Yeah. So the immediate impact was huge in terms of in the bond market right off the bat, and in turn then in terms of the U.S. dollar. Dollar index had been up around 85. It dropped within minutes down to 84, then down to 83. Currencies such as the Canadian dollar, went from 94.5 to 90, just under 96 cents in quick order. So you ended up with this across-the-board move of 1.5 to 2%. And it didn't matter what the product was, as it was related to U.S. dollars.
Now, you have been around the business for a long time. You and I have been talking for 5 years. Can you ever remember a time when markets were so Bernankified?
No, I mean, you get the odd event. You expect to see them, but not as frequently as we're getting now.
Why is that?
Well, I think it's still that there's a lot of money, there's a lot of hot money out there these days. If we look at basic trends, I don't think that you're seeing major differences. But it's the action within short-term periods, like within the day or within a span of a couple of weeks, where the money just seems to be bombarded with so much news. And it tries to react to every single piece of news. And, as long as, you and I go back, it used to be that you got your news in the paper the following day, people would react to it. Now I think you're getting too much instantaneous market reaction.
Yeah, it's going on in real time, right?
Yeah, and on top of that, you've got all the systems traders that are sitting out there with the automated programs. Mm-hmm. And as soon as a trend starts, they just start to milk it quickly. Momentum stops, they exit the positions. So you get expanding volatility. I'm just looking at the dollar index chart here. We were coming nicely off the bottom here in February. Then got into a March trading range. It was maybe 82 to 83 and a quarter for a month. Then it expanded. All of a sudden, the highs are now 84 and a half down to 81. And then a month later, they expand again, 80 and a half to 85. So we're just getting it, and the net result is we are at the same level that we were in the middle of March.
With a lot of whipsawing in between.
With a lot of that. So the dollar index is going nowhere, but individual currencies, there's some trends happening here. Look at Canadian dollar. We were trading above par at the first of the year. Here we sit at 96 cents, and that's up 2 cents on the week. Been a tremendous week. But,
that's a big jump.
We're fighting a trend. This is still a downtrend for commodity currencies right now. You see that in the Canadian, you see it in the Aussie dollar. Might be getting, might have had some excesses and ready for decent bounces, but still there are some trends on items such as that. The euro stuck in a broad trading range, 1.25 to maybe 134, 133 on the top end. So not too much excitement in that one.
One of the things Ben Bernanke and the Fed can't ignore, obviously, is that interest rates are going up. That's creating huge dislocations in the bond market. What's going on there?
Well, what you're getting is that the front end of the curve, the short money, the overnight money, that rate hasn't budged. I mean, we're sitting under 1% in terms of U.S. yields. You got Canadian yields at the front end of the curve, 2-year rates at 113. But it's that as you move out on the curve, if you're going to commit money for 5, 10, or 30 years, that's where the price action has been. And in terms of the dollar values here and the movement, we saw in the last couple of weeks, 10-year rates in the U.S. went up by 87%. We went up from just under 1.5% to just under 2.75%. Now, the numbers are still small, but the percentage moves are big. That was the 10-year rates. The 30-year rates went from 2.5 to just under 380. Still low by long-term perspective, but it's caused definite dislocation as far as the hot money is concerned, because they had been, utilizing these lower rates as far as the long end was concerned. So we've gone from, a year ago, bond market was in, we call it a get-me-in mode. Everybody wanted to be long the bonds, whether it was in the governments, the corporates, out to the municipal as you go. Everybody wanted to be in. Market sentiment was high. They look at bullish consensus. You had 79% of analysts and investors that are surveyed were bullish. And then we went through this rolling top in terms of the bond market. We had, for my work, we got some big overbought readings in the second half of last year. You got a rolling top. And so we looked at it and said, what can you get down to? Well, there's some long-term channels. We've had bond market, long-term interest rates have been dropping since 1980. And, took a look at it and said, well, long-term channel, where can you get to? And as of this week, we got down to the lower quartile of what I consider the major uptrend in bonds that we've had since the 1980 turn. Probably has a little bit more to go after a bounce, but we've got sentiment having gone, as I say, from 79% bulls a year ago down to 28%.
Wow.
So, now that we've had this big drop and interest rates, quote, are up, people are now convinced that they are going up. So this is pretty late in the game as far as this move is concerned. And I think Bernanke's comments this week really, he got best bang for his buck. Because it's like, if you want to do intervention in a currency market or any market, you do when it's most overextended, when you've got the most number of people on one side of the play, and you give them something that's counter to what they were expecting, and they're looking for an exit door very quickly. And I think that's what happened here in the bond market. Very oversold. Whether you're looking on a daily, weekly, or monthly basis, sort of down to the bottom end of a major rising channel. We had the commitment of traders, which is a figure that comes out from the Commodity Futures Trading Commission that shows a breakdown of small speculators, large hedge funds, etc. And we were sitting, as of the last 2 weeks here, with the lowest number of, with the greatest number of small speculative short positions that we've had since 2007.
What does that tell us?
Well, that just tells me that we've gone from the point where the very astute, say, institutional people had been sellers in the last year, basically when markets were up high and rolling, to the point now where we are down hard, and you've got the general public out there selling.
Yeah, no kidding. I mean,
it's late. It doesn't have to be the bottom, but it invariably becomes an interim low.
Interest rates going up, obviously causing huge outflows from bond mutual funds. Where's the opportunity now for all those folks?
Well, what you've had, the numbers in the States are pretty astounding.
Yeah.
There was $66 billion that was pulled out of bond mutual funds in the last 5 weeks.
Wow.
And that money's been moving over to the equity market, and as you can see in the U.S., you've got the S&P and the Dow, the Russell 2000, all up into new highs as of this week. But on the other side of the coin, during that break, the high dividend-paying stocks, which everybody had been attracted to through the last year and a half,
the defensive stocks,
they took it on the nose.
Yeah.
And so, whether it was banks or whether it was REITs or utilities, the MLPs, the Master Limited Partnerships, any of those items, they were down anywhere from probably 8% minimum to as much as 15 or 16%. And because of that, one wants to be an opportunist.
Mm-hmm.
You take a look and say, where are they providing kind of value that you see infrequently? And this is, I think, what people want to take a look at. You've got Canadian banks, probably the lowest yield out there is just around 4%.
That's decent.
The highest yield, without mentioning names, is up around 5%. The REITs, real estate investment trusts, have got the best yields we've seen in months and months.
Yeah, they're around 4% too, right?
Well, yeah. If you look at the ZRE, which is the equal weighted basket on the ETF, that's actually yielding over 5% right now. And remember, this is a dividend that's there. So there's good value. They may not be the final bottom, but for people who have need for cash flow, this is something we haven't seen prices like this. Just looking at charts here, April of last year was the last time we had an opportunity as attractive as this.
We used to say back when I was in the investment business, great companies on sale.
Very much so. Yeah. When people go to the grocery store, they want to see sales. Yeah. And when it's the equity market, the concern that they have is the momentum and when will something bottom, but there's a point at which you have to say, is there a value there that I can be comfortable with? And is the underlying company going to continue to exist? Is it going to continue to have a cash flow? If so, will that cash flow cover the dividends, et cetera? And, when you're looking at the major names, just think about flying over the country and take a look down at those big office towers, et cetera. They're not going away.
No. The share price may go down, but they're not going out of business.
Oh, no. And, for some people, capital preservation is a key item, but cash flow is important as well. But I think, when you do get these significant breaks of this magnitude, it pays to go out there and, put your toes in the water, close your eyes for a little while. As we look back in hindsight now, it didn't matter where in the fourth quarter of 2008 or first quarter of 2009 that somebody might have purchased. Most assets that had a dividend and cash flow out of them have done respectfully well.
Ross Clark, our guest here on This Week in Money. Ross is with CIBC Wood Gundy. We're talking about what's going on in the markets this week. Another great finish for the Dow and the S&P. Now, Ben Bernanke aside, we are coming up to some fundamentally important stuff. Earnings season being probably the most important.
Yeah, from here through the end of the month, I think something like 75% of the S&P 500 stocks will come out with their quarterly figures. And most of them have been scaling back in terms of their the consensus and the leadership they've been giving to the analysts. Back in April, I think the average estimate was for a 3% year-over-year growth, and that's now been scaled back so that most of the companies now are talking something in the way of a 3% level. So if you lower your estimates enough, then you can beat by a cent, and the market will like it for a short period of time. But it is the summer. Say we get these earnings out of the way. We are into the chattery phase of the year historically, and if one takes a look at a composite model of the market in terms of seasonality, both in terms of what it does, say, on an average year, where we know that you've got your best 6 months being end of October through the end of April. And then if you take a look at your presidential cycle at the 4-year window there, and you overlay the decennial one, so that's where are you in the period of a 10-year window, so in this case the third year in the decade. When you do the overlay of that, we've been pretty much lockstep this year. Got a little, the modeling would have called for a little better June and early July than we've had, but we've had a bit of a catch-up thanks to Bernanke. But moving forward here, it's natural for the market to put in a mid-late July high, a secondary high out in August, and then look towards your classic better buying opportunity out in late September, early October.
Ross, you and I have talked about the presidential cycle at length for a while here. Now, update me on what's going on. Usually it means a correction in the first 2 years of each presidential term. So sometime in the first 2 years of Obama's latest term, there's going to be a correction. Is that holding true?
I believe so, very much so. The election year itself typically ends well. You have follow-through into the summer, and the highs are usually seen by the time we get into the July window where we are right now. Consolidation phase will be running you, say, typically into, I would say, late October, November. Cycle work that I'm looking at right now is maybe pointing a little bit earlier than that. I'm thinking in terms of late September, early October for this year, and we'll see how it unfolds. For now, I think people want to be looking at the lows that we just put in this last week. Had it not been for Bernanke, the market would just have been up and testing the highs. Mm-hmm. So I think it would, and if we had started to roll from there as we move through July into August, that would normally be sort of the kickoff for the correction mode in the market. With the stimulus that we got in the marketplace here at the end of the week, I think you want to allow for maybe a little bit more volatility up around these highs. So you could come back, retest this breakout that we've had, but I don't think you want to be looking at the S&P or the Dow moving below the levels of, say, the last 2 weeks. And as far as the trading market or any of the individuals who would be trading are concerned, look for the best opportunity still down the road.
Ross Clark from CIBC Wood Gundy, our guest here on This Week in Money. Ross, here's a phrase I have not heard for a while, the Great Rotation. Here's a MarketWatch.com today. It's the Great Rotation, Charlie Brown. The long-anticipated shift from bonds to equities finally appears to have begun. Has it?
Well, I'm inclined to say that it started the better part of a year ago and accelerated into the last few months. Here we've got U.S. equity market up 18% on the year, and the bond market, I haven't worked out the numbers, but we've got to be down 135 down from 150, so we're down 7 or 8% there. So yeah, the long-term shift is in the process of happening. It's not the beginning of it by any means, and none of these things continue just ad infinitum in one consistent move. There's going to be a stair-step action as we move along. And right now, we've seen, say, the long end of the bond market move. We've seen a steepening of the yield curve. I think, in the next month or so, you're probably going to see that flatten out for a while. And then let's see what happens after that.
We're talking to Ross Clark. Hey, gold finishing the week up, Ross, at up 5%, 1285, biggest weekly percentage gain in almost 2 years. Gold, just like just about everything else, reacting to all the stimulus talk from the U.S. Fed this week.
Yeah, the percentage move there on Thursday in gold and in silver, pretty much matching everything else across the board. Now, when I was on holiday at the end of June, we got some interesting readings in some of the technicals that I do. The silver market had given back 75% of the complete advance from the 2008 low. And that is very important to me because there are key retracement levels that have shown up historically in silver. The 65, 75, and 85% levels have been very, very significant in terms of holding the market. And at 18 3/4, the silver market there in June was right down to that 75% level. From there, you typically get a very, very good rally. And on top of that, the monthly charts on silver, gold, a number of the other commodities, the grains such as wheat, corn, the coffee market, all produced for me, what I call a capitulation reading on a monthly basis. And that, if you take a look at relative strength or momentums, those are the kind of extremes that happen. You're lucky to see them once in a decade, very, very infrequent. And invariably, they will be followed by either a quick V bottom, but most often by a basing consolidation phase as the market then sets up for its next bull market. So the type of selling that we had, and just that culmination of it into the second half of June, was such a degree that it's very, very much like the final washouts that you see when you look back historically. So I think that for all that we've had some minor, some consolidations along the way, and then markets breaking pretty much consistently since last September, I think the chances for us to create a more lasting base are becoming better and better.
Last week, it was QE off. This week, it's QE on. I'm hoping Bernanke will maybe take the rest of the summer off.
Well, what did I hear? That he's wasn't going to Wyoming. Is that right?
Let's hope not. Ross Clark with CIBC Wood Gundy, our guest here on This Week in Money, wondering where gold is headed from here. Lots of chatter about taking a run at 1,300 in the next while, or could go the other way.
Well, I wouldn't be at all surprised to see the 1,300 level, and ideally something closer to 1,400. I think out of this bounce, we do finally have in both the silver and gold, you've got a tested low in that you put in that spike bottom at the end of June. We came around 10 days later, tested the low, and it held reasonably well. And, if we look at the mining stocks, we're starting to see, some buoyancy in there. It would be nice if we could have follow-through on the upside next week, because most of these markets, if you look at them on a weekly basis, have just had concerted pressure, just a cap on the market as we've moved over the last 20 or 30 weeks here. And so we were looking at silver on that basis. It managed to just poke its head out this week. I think if it can get up through the $20 level, that would, and we're just shy of that now. If it can push up through $20, that becomes a catalyst for a pretty good run. And say that would inevitably have the similar action with gold to the upside. We take a look at things like the platinum and palladium, which gave up far less ground in here. There might be some pretty good numbers to be had on the upside there.
Russ, what about physical demand for gold? We know it picks up in the second half with weddings and festivals in Asia. How much of a factor do you think that'll be?
Well, we're coming into the time of year where the seasonals kick in. Now, over the last few years, the physical demand has started to pick up at the end of June as we've moved through the summer, which is typical. It's a little earlier than what used to be typical in these markets. But if you do manage to turn the corner in July, they've had a pretty good track record as we move, quote, into the normal Indian buying season. Okay. So I don't know how much of a factor that is going to be anymore. You got too much political intervention happening in terms of imports and exports everywhere. So I think we've got to we have to watch this market, see what it shows us, rather than trying to second guess whether demand will be there or not.
Obviously, two of the big factors affecting gold are going to be number one, rising interest rates, and number two, a stronger dollar.
Well, but rising interest rates, I say we've had a rise. I think we're in that pausing phase right now as far as the rates are concerned.
So it's priced in.
Yeah, a lot of this is already priced in.
Okay.
By the time we get to the extremes that we just saw, it becomes old news. I mean, the key, the thing that you have to worry about is what you don't know.
And there's lots of that.
Yeah. I mean, as I said to somebody, like it was on Monday or Tuesday of this week, what can the catalyst be in the gold market? Well, we found out it was Bernanke and the dollar. It had nothing to do with gold. It was all the dollar.
We knew there would be a catalyst, but just didn't know what it was.
Yeah. With any of these markets, if you start to create a trend, usually starts slowly, with very few people getting on board, and then as it builds momentum, you gather more and more sponsorship behind it, and so you can start to step up and make higher lows, higher highs. But in the early stages, it's usually not that there's big demand pushing it. It's just that you finally run out of your sellers, and so the market just starts to ease its way higher. I'm hoping that we're approaching that level as far as some of the commodity markets are concerned right now, because clearly from the measurement perspective, the sellers have been cleaned, the buyers have been cleaned out with the amount of selling that we've seen.
Ross Clark from CIBC Wood Gundy has been our guest on This Week in Money. Ross, for folks who want to get in touch with you, how can we reach you?
Well, they can do it on the internet at ross.clark@cibc.ca, or give me a call here in Vancouver at 604-661-7759.
Hey, Ross, thank you, my friend, and have a great summer.
Always a pleasure, Phil. We'll talk to you in the fall.
The best of the best. Randy Elvis Frisky and his Las Vegas show band with Cassandra Frisky. August 16th, Surrey. 17th, Chilliwack. September 14th, Kamloops. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Sean Brodrick is back with us. It is always good to hear from Sean. This time around, Sean, you have some news for us. You have moved from Jupiter to Delray Beach. I should mention that's Jupiter, Florida, not the planet Jupiter, right?
Yes, that's right.
So why the move to Delray Beach? What's going on?
Well, I am working for the Oxford Club, and they're a group which, publishes financial stuff and all that. And right now I'm being published at Investment U. That's investmentu.com.
All right.
And I just had a story come out Thursday on Palladium. And, I'll be putting out more stuff. And certainly by the end of this year, I will have new trading publications launched. But right now, we're just, moving on into new stuff. It's a really good move for me.
All right.
And I'll also be speaking out at a conference in California Well, probably when people are listening to this. So
Okay.
that's coming up soon.
You have a great latest column at investmentu.com. Rodney Dangerfield of Metals getting the last laugh. Platinum and palladium kicking gold and silver's butt over the past 9 months. Palladium kind of below the radar for a lot of us. Bring us up to date. What's going on here with palladium?
Yeah, well, because that's really an economic metal. That's really an industrial metal. And while things like gold and silver and even platinum get to make frequent trips to the jewelry store, the only way palladium is used there is as cheap wedding bands. So it's not really a jewelry metal, not so much an investment metal either. And so when we saw the big sell-offs in the other precious metals, we saw palladium hold its own. Now, it was dragged down a bit, but the fact that it's used in the catalytic converters in cars really makes it, that's an industrial story. And then we got a big strike in South Africa, which is where a lot of palladium comes from. And so that's really putting a squeeze on supply. You put those two things together. I mean, we already saw tightening palladium supply anyway, because Russia usually sells a lot of it from the world's only palladium stockpile. They didn't sell much last year. Many people are now expecting that, in fact, their big stockpile is pretty much exhausted. And so we are seeing a real supply-demand squeeze, the makings for a big bull market. And so the recent low in that metal was probably the low, and it's probably heading higher from here.
Sean, Rick Rule a couple of months back said the South African mining industry caught between, and I love this line, caught between a rock and a hard place. He says wages have to go up, but the mining companies can't afford the extra money. This is tough times ahead for South Africa.
Right. Well, they may not be the best mining, they may not be the best run mining companies in the world, but their problem is that if they do raise wages, they have to lay people off.
Yeah.
Either way, it's going to tick off a very restive labor force anyway. I mean, there are very serious strikes going on there, and those people are not happy. They think they deserve a much bigger piece of the pie. And in the meantime, you have other costs rising. You have fuel costs, of course. You have the fact that the ore bodies that they usually find now have lower ore grades, which, raises costs all around that way. So you put those things together, and yes, their costs are going up. And in fact, there may be no real solution for the problems in South Africa. Many of those are very, very deep mines. And if you add in the labor troubles, we might not see those coming back for a long time. And so right now they're having a strike. I expect the strike to have some kind of patchwork thing put over it. When that happens, palladium will probably pull back. And I think that'll be a great time to get long palladium if you want long palladium already.
Little bit of news from Russia this week from Norilsk. You mentioned them earlier, the world's largest palladium producer, mentioning that they say the global supply-demand shortage is just going to get worse.
Yeah, and since they produce 41% of the world's palladium, maybe we should listen to them. Obviously, they might be talking their book, but I don't think so. I think they're just looking at things around there and saying, you know what, we really need to find some new supplies of this metal. Now, there are some new developers in South Africa, which is interesting. That's an interesting one because they're mainly going to use robots, and they're in a part of South Africa that hasn't been mined yet, and so they don't have the big labor historical troubles, legacy labor issues that the other South African miners have.
Unless the robots go on strike.
Right, exactly. Robot rebellion.
Yeah.
But also, North America has some interesting palladium developers, up in Canada, for example. And so I think we'll see those move along. So at a time when gold projects may have trouble finding funding, palladium may do very well. At least it seems to have all the ingredients for a big extended bull market because automobiles are in a virtuous cycle. Many people put off buying new cars while there was a global recession going on. Now they're starting to buy new cars, and all those cars, if they run on gasoline, need palladium in them because you need those for the catalytic converters. And so that's just a very virtuous cycle, not only for automobiles, but for palladium as well.
What about the huge growth in automobile demand from places like China and India? That's got to have an effect on palladium as well.
Well, yes, of course. I mean, it isn't just a U.S. story. In fact, China passed the U.S. in like auto sales back in 2009. They continue to expand. Everybody over there wants to drive, and so, that's a huge growth story. India, not so much, but they're still coming along. I mean, maybe not as big as China, but they're still big. And then you look around the rest of the emerging markets, South America in particular. Everybody wants to drive down there. And so that's a big, bullish story.
One of the places you mentioned in your article, Sean, Zimbabwe. I have not heard much about palladium and platinum mining in Zimbabwe. Any idea what's going on there?
Well, I think you might be confusing that with another story. I don't mention Zimbabwe specifically, but I can tell you that I wouldn't invest in a mine in Zimbabwe. Now, there are mines in Zimbabwe, and that's the tantalizing, frustrating thing. They're actually very good projects if they didn't happen to be in Zimbabwe. Mm-hmm. Political risk is something that we have to figure into every project at this point. And so that's why projects in, say, North America start to look much more attractive, because you just don't have that political risk that you do with other projects. Now, there are certain mines in, say, North America, I'm thinking of Alaska particularly, that are never going to be built because of the political risk, but those generally tend to be, specific to those projects. Most of the time, it's easier to start a mine in, say, Canada than in, some other part of the world where you have to pay everybody off and you have to go through this and that, and then some new guy gets elected and he hates your project for other reasons, and so it's a long process in those other areas. And so that's why, certainly in Canada, I think it's a place people have to look at.
Sean Brodrick from InvestmentU.com, our guest here on This Week in Money. I looked around a little bit. I could only find a couple of palladium miners in North America. Here's one, North American Palladium. They operate a mine in Ontario, and they made the news this week. Folks at CIBC dropping their price target in half.
Well, I said I like palladium developers. I didn't say I like palladium miners.
No kidding.
In fact, I don't like any of the current palladium platinum miners. I like the developers because they have more interesting stories, and they seem to be run by smart people. At least some of them are. Some of them probably won't get anywhere, but I think there are certainly ones you could buy. The thing is, and everybody has to be aware of this, in this particular market, when you are buying a developer, you're taking big risk. It's just that I happen to like those more than I like the current North American miners, like North American Palladium. I would not buy that one now.
The only other producer I could find, American producer, Stillwater Palladium, and they are have an interesting pedigree. They're half owned by the folks at Norilsk.
Yes, and they are interesting, and they actually have some good stuff going along. But again, I think they face some real problems. And everybody can make up their own mind. And if that's a producer you really want to buy, then it's one you can look at. However, an easier way to invest in this would be through a fund that owns physical palladium. There are two we here in the States can buy, which is the ETF's Physical Palladium, symbol PALL, or the Sprott Physical Platinum and Palladium Trust, which is symbol SPPP. And I believe you have one up in the north of us as well, too, or at least access to it. And so, people can make up their own minds on what they want to do, but I see the price of the metal going higher. That doesn't necessarily guarantee that the miners will go higher, because the current miners have problems, and they'll have to surmount those before they can enjoy the boost from the actual metal.
Now, is getting involved in these ETFs, are you doing this for the long haul, or is it just a trading opportunity?
Oh, it's at this point just trading, let's face it. Over the long haul, you have to be extremely careful what you buy. Now, there is a big bull market in palladium, so I might have some loose stops on that one, simply because, it is rather volatile, the price action. And the big bull trend should be up until that big bull trend changes. You want to be on it. But nowadays, you don't want to get married to anything, I don't think. Well, except your wife, of course. But in the metals market, you don't want to get married to anything, because the story can change. Now, stories can change for the worse. They can change for the better. Just this past week in the precious metal market, we saw, some signs of hope in a place that's really been underwater for a long time. Right now, though, I would say of the metals, palladium certainly looks the strongest, and at least looking at the setup right now, that's the way it should continue for a while.
Talking about the other metals, about gold specifically, we had some gold news today in the wake of Ben Bernanke's speech or non-speech yesterday. Bring us up to date on what gold's doing.
Well, here's the thing, is that we see many different voices in the Fed, and that's the way Ben Bernanke likes it. He likes being the head of a committee where everybody gets to speak. And so they released the Fed minutes, and at first people saw those as dovish, so everything went up. And then they looked at the minutes and they said, oh no, that stuff there was bearish, and so everything went down. And then, later on, Ben Bernanke spoke, and he said, you know what, we'll keep doing this stuff until we see basically the labor market improve. That's what he's really looking for. And so now everyone's taking that as bullish. And so it's always a question, which Ben Bernanke is going to come out and speak today? And yesterday we got the much
Evil
more dovish
Ben.
one. That doesn't necessarily mean that's the one that'll be speaking in a couple weeks, but certainly the market pays attention to him. But if you're looking at the precious metals anyway, and I think we've made the case for palladium, people can either like it or not, but if you're looking at the precious metals, what you really need to be looking at is what's going on in places like China, which is probably going to take up half of the world's mine production this year or next. I mean, they are going to reach that milestone at some point. With the actual mines that are in China, all of that production goes into China, and with the huge imports they have, they are going to soak up half of the world's mine production. And also India. Now, India has really tried to clamp down on imports. They've done a very good job. I should say imports of gold. This is driving more Indians into silver right now. But, that might change as well. But with all the imports into China, with the tremendous buying we're seeing by the central banks, which continue, and it's funny how, all the banks say, oh, this is a barbarous relic. You don't need to own gold. Why do they buy so much of it if they say we don't need to own it? It's really kind of funny about that.
Yeah, I've always thought that.
You put those things together, and I think that that, along with the fact that many miners can't make it at current prices, it just kind of puts a floor under the price of gold. Can we go lower? Of course we can. But that will probably be a spike lower, one that comes back rather quickly, and such a spike would be a buying opportunity. Silver, the same thing. In fact, I bought silver this week for myself. That certainly does not mean you should run out and buy silver. You should only do what is good for your own accounts, for your own money, and I don't know your own history. But at this point, I think silver is cheap. And if it goes down, it'll be a little disappointed, but you know what? It's much cheaper now than the average cost of production. It can't go down that much more. And so I think it's a good time for me to pick it up.
Check out Sean Brodrick's latest column, Rodney Dangerfield of Metals Gets the Last Laugh, at InvestmentU.com. And follow Sean on Twitter at Sean Brodrick. Where else would you find out that the Swingline Limited Edition Series 747 Rio Red Business Stapler was on sale? I ask.
Yes, Office Space. That's the stapler from Office Space. And if you're a fan of that movie, as I am, that is the stapler to own.
Perfect.
So I'm bullish on those staplers.
Hey, Sean, thanks for talking to us. Good to hear from you.
Hey, thank you very much.
Thanks to our guests, Ross Clark and Sean Brodrick. And thank you for listening. I'm Phil Mackesy. We're back next week with Jim Goddard and more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.